Good evening, everyone. We will be getting started in just a couple minutes. Good evening and welcome to tonight's webinar, Financing Dental School, How to Navigate the 2026 Financial Aid Changes. I'm Linda K. Tyler, the Director of Business Development for ASDA. And we are glad that you have joined us as we have a very informative and interactive presentation planned for you this evening. During the presentation, we do encourage you to submit questions via the Q&A feature, and our presenters are eager to answer your questions and help you understand more about student loan financing. We'd like to thank Juno as the sponsor of tonight's programming and for their continued support as a Strategic Alliance program member. I would now like to introduce our presenters, Melissa Lowry and Diego Aragon. Melissa is head of dental partnerships and growth at Juno, bringing over a decade of experience and at the intersection of dentistry and communication. She previously served as communications director at the Alberta Dental Association and as chief marketing officer at an AI health tech company, having personally navigated and paid off $500,000 in dental school loans in 2024. So, Melissa brings a firsthand understanding of the financial challenges that dental students face and a genuine passion for helping students find better solutions. Diego is the head of graduate students at Juno, where he leads the company's efforts to reshape how students finance higher education. He oversees growth and partnerships across MBA, law, medical, dental, and other graduate programs, working to challenge the traditional lending model by using collective bargaining power to secure better rates and outcomes for borrowers. Diego has built his career in finance, focusing on scaling lending programs and improving access to credit. He earned his MBA from the University of Chicago Booth School of Business and holds a bachelor's degree in economics from Universidad Iberoamericana. Please join me in welcoming Melissa and Diego.
Thank you, Linda. Appreciate the intro for both of us today. I'm impressed with how you got Diego's university right because I briefly tried to pronounce it and I was very inaccurate in my very American way of
You got
saying
to
it.
learn how to roll the R's, right, Diego?
There you go. You did a great job, Linda. Thank you so much.
You're welcome.
So we are super excited to be here tonight and to do this webinar with you guys. It is something that Diego and I do on a regular basis, and it's something that so many students right now have questions on what the changes look like, how to navigate them, what best practices are for even going about financing dental school in this upcoming year. And so hopefully by the end of this, you guys feel confident in your ability to know what you should be looking for, how to improve your own outcomes and things like that. As Linda mentioned, please put your questions in the chat. We'll kind of either be answering them through there or we'll pause periodically and one of us will switch off and read them to each other while we're talking. So that we can answer all of them as we're going through and make sure that anything that you don't know or we are unclear about, you guys get. So, with that being said, I'll do our quick little disclaimer that we have on here. We're going to talk through a ton of financial stuff today. The goal is for you to be able to make your own financial decisions for this. We are not an investment advisor. We're not a financial analyst. We're also not lenders. I can't guarantee that you're going to get a student loan. However, hopefully you take the info away from this and you do qualify for student loans because you implement what we talk about. So, in any case, you can read the rest of it, but essentially that's the jumping off point. So, let's do this. Um, our quick agenda. We're going to talk through. So, we actually already got introed, so we really don't have a whole ton to intro ourselves for today. But then we're gonna talk through. Diego's gonna talk through the federal changes, going through what's different this year versus previous years for all of you that are incoming students. We'll talk through the budgeting and kind of how to jump off of that, private lending, and then essentially how we can help answer your questions if you have any more of them. So, without further ado, Diego, are you ready to take it away?
Let's do it.
Let's do our first poll question. Actually, I forgot that this is the first slide on here. So, um, love for you to answer. Let's assess what our options are. I actually don't remember. Do we get to see the answers of these when we're going through this?
I actually do not know, but yeah, let's give
Yes, you will get it. You will get an
Oh,
opportunity to see the answers.
okay, perfect.
awesome.
I was like, I
Okay.
should have been listening when we talked. I was listening better when we talked about this earlier, but um, yes.
No, they'll
So
be coming up once everyone had an opportunity to submit, then you'll get a chance to see where people land.
perfect. This is going to
Awesome.
give us a good jumping off point about everybody's thoughts and fears. A lot of times when we talk about financing, people get I'm going to say the worst part of pre-dental Reddit in their minds, and our goals is to walk away from this today being like pre-dental Reddit is the exception, not the rule. So, um, pretty good. I guess getting a bad interest rate and all of the above is kind of the
It's
most
gonna
frequently. Well, let us help answer how to get a better interest rate today. I feel like this is a great jumping off point for us. So, with that, let's get into the federal. We'll talk about all the rest of that stuff through here today. So, let's do this. So, oh
awesome.
wait, next
Yeah.
poll question, I guess. Just kidding. There's another poll question because I can't see the screens that are popping up after this on here like I can with Google normally. So, I guess we'll start this. Well, Diego, you can kind of talk through the changes if you want to talk through the poll question, but
Yeah, let's just get it started with the first topic at hand, right? Which is the federal loan changes. So chances are that if you're going to dental school this year, you've heard about, there are some changes coming your way on the federal student loan program. Let me just start by giving you some context, right? As of today, basically 2025-2026 academic year, dental students in the US could access two federal loan options: the direct unsubsidized loan option and then the grad plus loan option. Each of these two loans has its own unique set of terms, right? They both have a different borrowing limit, a different interest rate, and then a different origination fee. Historically, dental students tend to use both of these options to fund everything they need for dental school. Keep in mind that, I guess, go back just quickly one slide, Melissa, if you don't mind. Grad Plus allows you to borrow up to the cost of attendance. Keep in mind the up to the cost of attendance term. That's a term we're going to be using throughout this presentation. We'll dive deeper into it in just a few moments, but the cost of attendance basically is what the school is telling you you will need to pay or attend their program for that academic year. Okay? So again, historically, dental students use Grad Plus to fund everything they need up to their cost of attendance. Now, what's the one big change that is happening this year? So starting July 2026, the Grad Plus loan option is not going to be available anymore for incoming students. Okay. So what are we trying to compare here on this slide? We added a third column, as you can see, with the private student loan options. So basically, with a private loan, usually you can also borrow up to your cost of attendance. But unlike federal loans, the interest rate that you would get on the private side will depend on your credit worthiness. Okay. Historically, I haven't seen origination fees on the private lending side. So if you ever come across one, sort of a yellow flag, keep shopping around, right? So for now, we'll just add it as none on the origination fee side. Well, one important distinction between private lending and federal loans is that on the private side, you will not see the public service loan forgiveness and the income-driven repayment plan features that the federal government offers. We understand that that is very important for dental students, and we want you to use them, right, in your favor. But the reality is that private lenders will not necessarily offer that to you, okay? Now, one thing I'll mention here is that the federal loan subsidized loan is going to stay, right? And the limit got increased for professional degrees like dental school to $50,000 per year. Now, the interest rate, as you can see right now, there's a footnote in there. That interest rate is going to get set by Congress roughly at the end of May. Each year, that interest rate gets reset. So right now, we just do not know yet the interest rate that's going to be applicable for the academic cycle 26-27. But very likely it's going to stay very similar to that. The origination fee will not change for this coming year. If we can go to the next slide, Melissa, please.
Yeah, there's a question on here right now about the current students grandfathered in, or will they also be borrowing for private as well? Maybe we pull in a residency thing for that.
Well, yeah, depends how you define current students, right? If a current student will stay in the same program, and if that student has borrowed from any federal loan for the specific program they're currently enrolled, then yeah, they will be grandfathered in. Now, if say a D4 is going into a specialty program this fall or after July 1st, 2026, then technically you're changing programs. So you will lose access to Grad Plus. Perfect. So the second big change that the One Big Beautiful Bill introduced last year on the federal student loan program is the repayment plans. I'm not going to get into the weeds here because I know probably many people here are just at least 4 years away from having to decide between these options and getting to the nitty-gritty of it. You're going to have two options, right? The first option, which is like the standard option, is the standard repayment plan. I like to call it the mortgage style repayment plan. Why? Because your monthly payment is not going to change. All right. It's the same throughout the life of the loan. What's going to determine your monthly payment, other than the interest rate, is going to be the loan balance you have in your portfolio. Okay. As you can see on the screen, it could be as high as 25 years if you have more than $100,000 on federal loans, which we expect dental students to have. And then on the other hand, there's a new repayment assistance plan being introduced by this bill, which basically is a percentage of your AGI or adjusted gross income will go towards your monthly payment. Okay. Again, as you can see on the screen, it could be as high as 10% of your AGI or as low as $10 per month. Next slide, please. Thank you. So we wanted to show you this illustration to kind of give you a sense of how important private debt is going to be in your debt stack as an incoming dental student, right? So let's assume that you're going into school that has a cost of attendance of $110,000 per year, right? You're not getting any scholarships. You don't have any savings. You don't have any family money. Meaning you're going to have to fund 100% of your cost of attendance, right? If that's your case, then we expect you that by the end of your 4-year program, you'll have roughly $200,000 worth of federal loans. Not roughly, like actually $200,000 because you'll be maxing out those $50,000 per year. And then roughly $240,000 worth of private loans. Okay. Now, everyone will have a different situation, but roughly you're seeing at a debt mix of, more than $200,000 on private loans plus the $200,000 on the federal side. Yeah, next slide, please. Oh, actually, Melissa, I'll throw this back at you since you're more of an expert here than I am.
Diego does not like talking about this portion of it, but one of the questions that we get asked regularly is like, okay, what other funding options are there for dental students? Unfortunately, there's not a whole ton. You are more than welcome. We always recommend you to go look on the ASDA website, ADIA website. Some of them do list scholarships and grants that you can potentially apply for, but none of them are really going to be covering the full cost of attendance, tuition fees, etc. There's a couple you there's a public service that you can do as well as the health profession scholarship program. If you are unfamiliar with these, I would highly recommend talking to the recruiter or looking more online because neither Diego or I are experts in either of the public service or the military aspects of financing dental school. Both of them require some sort of service after school in exchange for tuitions, fees, and typically a stipend while you are in school. Each of the branches of the military for the HPSP are a little bit different in terms of what their criteria are. It is also both of these now, especially this upcoming year, are very competitive to get into. I'm not sure about all of the branches of the military, but the Army has about 80 spots a year that they are filling with for the HPSP. Obviously, there's about 7,000 dental students that get accepted every year. That's a very slim minority of students that are getting this. And this year, they've had such huge influx of students with the upcoming changes. It's very competitive. You still need to be applying and being the same things that you would be doing for dental school, letters of recommendation, DAT scores, extracurricular activities, and things like that. So super important for you to assess this as an option for you. They may cover 2 years, they may cover 1 year, they might cover all four. Both of this one, as well as the public service, where you're going into working someplace, committing to work someplace rural after you're done school, could be great options for you to help support funding this with the federal loans as well. So would highly recommend looking into it and applying as early as possible for both of those situations. So next, we'll talk about my favorite aspect of this, which is the very beginning stages of assessing how you're going to get loans. So we always talk about budgeting first because this is the foundation point. If you have never looked at a budget, thought about it, paid attention to how much money you're spending every month, now is the time because this is the first time in 20 plus years where your ability to fund school directly is impacted by what you're doing in your undergrad or in your gap year and things like that. So, with that, we're going to start with the cost of attendance. So, Diego kind of mentioned it. I know it's like a question on here right now. Your cost of attendance is listed on your school's website as well as is included in your financial aid package that you should be getting from the school once you're accepted. This will include basically everything that the school says that they think that you're going to need to live. Tuition, fees, rent, food, utilities, all of that kind of stuff put into one. The maximum amount of student loans, both federal and private, that you can take is the cost of attendance minus any aid or scholarships that you have been given. So, with that, we start with budgeting because you need to know how much money you are spending on a monthly basis and if that is going to fit into the school's cost of attendance that they have listed for you. It is very important for you to pay attention to the individual nuances of the cost of attendance. There are some schools, for example, UOP says that they expect you to have shared housing. There are several dental students that I have talked to that have been surprised that cost of attendance is not including a single bedroom apartment, it's including living with roommates. So these are the kind of things that you need to look at and be aware of before you assess your loans because if you run out of money, you have to figure out another way to fund this essentially because you'll have to get a personal loan, some family, a side hustle of Uber Eats or whatever it is. There are extenuating circumstances where you can talk to the financial aid office and customize the cost of attendance depending on what the circumstance is. This is something that they are very strict with because they have federal regulations that they need to play into. So typically it's like if you have dependents, if you have a medical condition that you have to pay extra for, or situations like that. It is not, I have an expensive car payment that I need to make, that kind of thing. Everything with the cost of attendance and your loan amounts, we highly, highly, highly recommend that you talk to your financial aid office first, ask them all of your questions about the cost of attendance and things like that, because they will be the best option for you to know what you should be doing moving forward. So please keep them in your conversation at any time when you're talking about loans and what you need to do with them. So with that, I won't actually switch over to it. A lot of times we talk about this dental calculator that we have, and then I switch over to it and we kind of walk through it. But I would highly recommend that you scan this. If you do not want to scan it right now, we will send it as like an additional resource after this. But we've created this dental calculator for you to put your school's cost of attendance and all their tuition fees, etc., of what's expected from the cost of attendance, as well as estimate your own monthly expenses so that you can assess the amount of loans that you will need. When you look at the budget calculator, it allows you to estimate this with your total program expenses based off of your own circumstances. It allows you to add in any aid or like family assistance and whatnot that you may have, and then you can go through and see the total amount of loans that you'll need. There's another page if you scroll down to the bottom of the calculator where we talk about this when we meet with students. It basically allows you to assess the different repayment options that you can kind of play around with when you're looking at different private loan terms. So you can see the difference between paying a 5-year term versus a 15-year term, 7% interest versus 9%, and see what those differences are so that when you're comparing lenders, you know exactly what that payment's going to look like moving forward. So I would highly recommend that. This is like free, just like make a copy of it, keep it for yourself. If you are not an Excel person and this is like an overwhelming thing to look at, unfortunately, you gotta man up. This is so important. Finances and financial aid is not something that's really talked about a whole ton in school and best practices for it. Do the bare minimum on here. Go through your credit card statement. Put all of your stuff in here so that you at least have a jumping off point of how much money you need and how much you can realistically live on. So that's my first caveat. Diego's going to get into a little more nitty gritty of like the student loans and actually what you need to know about it. I'm pretty sure we have a poll first, but
We do.
let me.
Yeah.
Yes, we do. Okay. This is our first time that we've done polls when we do these. We do these webinars a lot, probably like, well, I've already done one today, but we probably do 2 or 3 for a week and things. And this is the first time we've done polls. I kind of feel like I need to add them in on a regular basis because they're kind of fun. So, um, this is, I'm curious to see where everyone stands on this.
And
Oh,
while people answer this one, I'll just encourage obviously everyone to make a copy of the calculator that we just shared. We've gotten very good reviews out of it from other dental students. And go through that exercise, right? My recommendation is try to talk to other students at the current program you're heading to, right? That gives you more inputs as to how to go about your budget, right? That goes a long way. Well, I think we have the results already. Not yet, right? More than half of people have not yet started looking into private loans. So I think that's in a good way, good, because you'll learn a lot of it in the next few slides. Thank you for sharing that. So again, once you've gone through that budgeting exercise and you've come to the conclusion that you'll need student loans to fund your program, I'm going to give you some quick overview of the process, the timeline, what to think about when selecting these loans, how to make sure you're getting the best interest rate. So bear with me these next few slides. I'm pretty sure there's going to be a few questions coming up in the Q&A. So in terms of process, usually, but I mean like more than 90% of students take their loans in the summer ahead of each school year, okay? So the cost of attendance, as Melissa was saying, is going to be given to you by your school every academic year, right? So for dental school, potentially you'll have 4 different costs of attendances, right? 1 per year. So you'll get your cost of attendance roughly by the end of spring. And in summertime, you apply for your loan, right? Obviously, once you know how much you need to borrow, where you want to borrow from, and then you just go ahead and complete the process. There are some cases where students might need additional funding halfway through the year, right? Or they want to adjust the loan amount they got in the summer. Keep in mind that that's possible for you to do. Again, always loop in your financial aid office. They are here, they are there to help you. But there's an option for you to adjust your amounts. So basically, yeah, once per year over the summer. So as I was saying just a few moments ago, we're looking potentially at you graduating with 4 different private loans, okay? Now, this next slide is gonna kind of give you an overview of what actually affects your interest rate, right? And you being eligible for loans. One thing we haven't touched base yet is key distinction in students, right? And that distinction is international students versus US citizens, okay? If there are any international students in the audience, and you don't have a US cosigner available, to help you out get loans, then shoot me a note. I'm happy to connect with you. I was an international student myself at some point, but your options might be different from your US peers, okay? And what I mean by that is going to be limited options and potentially more expensive ones. But in terms of everyone else being eligible, well, you have to be either a US citizen or a permanent resident, or have a cosigner if you're an international student. After that, kind of the most important thing would be your credit score, okay? Credit history, many lenders actually take that into account in different metrics, but very common is for them to be looking for at least 3 years of credit history. Another thing that's considered sometimes is what is known as a debt to income ratio, right? How much debt you have at the moment of your application and how much income you're making, right? More on that in a little bit. After that, they might ask you to add a cosigner, right? And that cosigner must comply with the credit worthiness criteria that they're asking, okay? And these last two things we like to mention because the timing of your application might also play an effect on the interest rate you're seeing, okay? What do I mean by that? Many lenders, their cost of funds or the interest rate in the market moves throughout time, okay? So that's why timing of your application might also play an effect on how high or low your interest rate could be. And last but not least, the terms of your loan, all right? I have a slide dedicated for this, but just keep in mind that private lenders, unlike federal options, would offer you different options on how to kind of customize your loan, okay? Okay, this is what I was saying, right? If you're an international student, you'll need a cosigner to qualify for at least the Juno deals, more on that in a little bit, and the US local market. And usually lenders ask your cosigner to be a US citizen or a US permanent resident. They have to have a minimum credit score between 650 and 680. Again, 3 years worth of credit history, and they must have stable income. They like to see at least $35,000 in the US, okay? Again, send us a note if you're an international student and you need further guidance on it. We have a lot of resources and we have a lot of knowledge on how to go about it. But roughly, you're looking at someone who complies with this criteria. As I was saying, your credit score is one of the most important things that lenders will take into account when assessing your credit worthiness, okay? You might have heard there's a few different credit scores out there, right? FICO score, TransUnion, your Equifax. The reality is that we see lenders using FICO score for student loans, okay? As kind of a quick recommendation, personal recommendation, there's a few free resources out there that you can use to kind of keep track of where your FICO score is at this point in time. I personally use the Experian app. It's the free version, right? And no affiliation to Juno. But it's pretty easy to kind of keep track of, where your credit score is at this point in time, and then what you can do to kind of improve on it. There's a few metrics that they take into account that you can improve on to make sure you're maximizing your chances of getting a higher credit score in the short term. I think I have a poll after this slide. Yeah, there you go. Do you know what your FICO score is right now? Yes, and it's above 720. Yes, but it needs work. What I mean by it needs work, let's say it's below 720, or you have no idea. I'm very intrigued about the answers to this question, to be honest.
I am too. Every time we talk about this, there's a few things that we tell everyone to take away. And if you're going to do anything while you're watching this presentation or this webinar, it's go look at what your FICO score is right now, because that is the jumping off point for everything. So let's see. Look
All right.
at that's actually pretty
Nice.
good. I was not expecting those numbers to be like that. So
awesome. That's good news for the majority of people here that have a credit score above 720. I'll tell you why we were asking 720. But let me just first start by addressing the credit history aspect of the few things that I mentioned in a few slides ago in terms of what lenders take into account. So First recommendation is if you do not have a credit card right now, and you know you're going to need a student loan in the near future, go and open a credit card in your own name, right? Make sure it's not an extension of someone else's credit card. Even if the limit on that credit card is very low, doesn't matter, right? Anything is good if you don't have anything at this point. Okay. Obviously, please make sure you're using it responsibly, right? We like to say throw in a Netflix subscription in there or something like that, and pay it on time every month, right? One of the couple of things that FICO score takes into account when assessing your credit worthiness is how big your credit limit is, right? And what percentage of that credit limit you're using every month, right? So those are very important things that are considered when assessing your credit score. Now, if you have undergrad student loans, some lenders might consider that as credit history. Some lenders might say only if your undergrad student loans are in repayment, then that would be considered as a history. But generally speaking, undergrad student loans might give you the credit history that lenders are looking for. Sorry, Melissa, I see you're unmuting yourself.
So what if you don't have 3 years? What if you only have 2 years of credit history right now and you're needing loans?
That's a great question. There's so much you can do, right? You cannot change time, obviously. But in that case, if you know you're going to, if you are going to be applying this summer, right? Obviously, you're not going to have 3 years by this summer. So in that case, I would recommend start thinking about a cosigner. Obviously, a cosigner with more than 3 years worth of credit history. Okay, great. We like to show this slide because quick tips on what are the few things you can do to improve your chances of getting a great interest rate. Okay. Again, number one, have your own credit card for as long as possible, as soon as possible. Emphasis on use it responsibly, please. If we were to give you a target, again, back to the poll question, a target in terms of number for your FICO score, it'll be 720. Okay. I'll tell you why. Many lenders will say the minimum credit score you need is between 650 and 670, right? Or mid 600s, what they say usually. Now, that's a minimum they would like to see to give you rates, but it doesn't mean you're going to get good rates, right? When we start seeing the quote unquote good rates, so those rates kind of improving, is above the 720 roughly FICO score, right? So if I can give you a target, would be at least 720. Anything above that, perfect, right? I should say perfect. Everything above 800, everything above 720, great. That's very good grade score. A quick hack: try to pay off your credit cards before the statement is produced, right? So let's say your statement is produced every month on the 15th. If you pay off your balance on the 14th, then the amount reported to the credit bureaus is going to be zero, right? So that's a great percentage of utilization of your credit limit. So if you have the ability of paying your credit cards before the statement is produced, that's going to go a long way in terms of the impact in your credit score. If you're thinking about getting student loans in the summer, for example, and at the same time you're thinking about getting an auto loan, right? Because you need a car to go to school. My recommendation would be try to do first the student loan and then the auto loan, right? Because if you do first the auto loan, you'll get a hard credit check for that before you apply for a private student loan. And the other way around, it has less of an effect in the auto loan than it has on the private loan, because the private loan is an unsecured loan. So just a tip, if you find yourself in that situation. And then lastly, kind of addressing the question that was asked just now, if you cannot comply with any of the things we just mentioned, start thinking about a cosigner, okay? A cosigner doesn't have to be a relative of yours, right? It could be a stranger on the street. If you convince that person to sign a loan for you, then that's great. As long as that person qualifies on their own, right? Meaning they have the minimum credit scores, they have the credit history, they have the income. Usually when you use cosigners, they do require income, right? So if they qualify under that criteria, then they could be your cosigner. Now, remember I was saying that the terms you select on your private loans would also play an effect on how low or high your rate is, okay? So let me just give you a quick kind of overview on the types of terms or options you can see on from a private lender, right? Starting with the type of rate. It could be fixed, it could be variable. Fixed, as the name implies, is going to stay the same throughout the life of your loan. Long term, it could be as quote unquote aggressive as a 5-year loan term or as long as 20 years, right? And then these are the options that I've seen in the market, that some lenders offer. I think one lender also offers an 8-year, which is not in here. But the point of this slide is just to kind of give you a sense of the amount of options you might potentially see from a private lender. Okay. It doesn't mean that every lender is going to offer you all these options. It just kind of the up to options you could potentially see. And the repayment plan is also something that plays a significant role. Okay. Think of a repayment plan of what you can do with your loan while you're a student. Okay. Obviously, by the time you graduate, and there's a grace period that lenders usually offer after that, you're gonna have to pay back your loan one way or the other. But what happens in between? And this repayment plan feature is addressing that part, right? You could either be very aggressive and pay both your principal and your interest while you're a student, or only your interests, or pay just a small amount, which is known as a fixed repayment plan option, dollars per month, or do not pay anything while you're in school and just defer 100% of your loan. Okay, I do not expect full-time dental students to be making interest payments or both principal and interest, right? Because obviously the assumption is that you don't have any income while you're a student, so it's going to be hard for you to do that. But anyway, to kind of illustrate the point of how many options you might see from private lenders. If we can go to the next slide, Melissa, please.
Yeah. There's a question about the hard rate checks really quick that I figure maybe we address that before we go on further since we just kind of talked about it. Somebody said, I've been approved for an apartment, but they didn't say anything about a credit check. Do they still have to do that anyways? I put down I don't have a job and that I'm a student, but I put my mom as a cosigner. She has a job. Would they be hard checking both my score and hers?
I'm no real estate expert, so I wouldn't know. My recommendation would be to ask, your landlord on what process they would follow. I think in some cases they do hard credit checks, but I cannot say yes or no, right? Because I honestly do not know the context of that. But that's a great way of thinking about it, right? Think about those things where you're applying, whether it's an auto loan, whether that's an apartment, and how that may play an effect on your credit score. Okay, great question. We wanted to show you this slide as well. It is just for illustration purposes, right? Let's assume that you're thinking about a 5-year term or a 10-year term or a 15-year term, right? And usually I see students saying, hey, I see the lowest interest rate on a 5-year term. I'm just going to go ahead and select the 5-year because that's going to be the cheapest financial option. And yes, from a finance perspective, that's accurate, but I want you to take a look at the monthly payment after school column here, okay? Think about, going back to Melissa's tool on doing your budget, try to think long-term, right? And mid-term. What's your situation after dental school? Do you think you're going to be able to make $7,000 in post-tax money for private student loan payments, right? Or not, right? I don't know. Maybe you can, maybe you cannot. $7,000 is a lot, right? Assuming you have like $300,000 worth of private loans, it's going to be a lot, right? But take a look at the trade-off between, say, a 10-year and the monthly payment, right? So the interest rate on a 10-year might be just a few basis points above the 5-year. That's usually what we see on these curves. So financially speaking, it's not that much more expensive. But when you take a look at the monthly payment after school, it's significantly lower, all right? And then obviously as you go ahead in the curve, it's going to be lower and lower the monthly payment, but then the higher the interest rate is going to be. That's a trade-off I want you to think about, okay? And I personally, when I was selecting my private loan options, when I was in grad school, I was thinking about my ability to pay them after school, not only the financial cost, right? So anyways, just food for thought. on how to approach or make this decision?
One comment
Yeah.
on that. Yes, I would say coming from experience, you do not know what your job's going to be right out of dental school. It is most likely going to take you a few years to find the right fit for you. Would highly, highly agree with Diego's point of erring on the side of caution when you're choosing your loan types because you cannot switch it once you decide that you're paying the 5-year one. The lender's not going to be like, oh, actually, you can switch to the 10-year if you come back and say, hey, I can't pay this. Err on the side of caution. We can discuss refinancing at a later point and such. But aside from that, there's a bunch of questions here, so I want to get to those while adding that caveat on there. Um, can you explain a little better the fixed versus variable rate types as options?
Yeah, I didn't do a good job on that one. Sorry. Basically, fixed rate is just the same rate throughout the life of your loan. So in this example, that 6.5% interest rate is going to stay the same until you pay off that loan. A variable interest rate would move over time as the market moves, right? Don't want to get too technical here, but there's a benchmark index that all these loans are indexed to, which is called the SOFR interest rate. That rate is going to be moving every month, right, as the market moves, and your interest rate will move accordingly, all right? Truthfully, I think more than 95% of students that we work with at Juno select a fixed interest rate because you do want to be able to budget as accurately as possible, right? Don't want to deal with the risk of interest rates going up or down. You never know what's going to happen. You're going to go to a 4-year program. So that's a long way, of, I guess, exposure to your interest rate before you can refinance and do something about it, right? So my recommendation would be go fixed. I know we're running short on time, and I do want to get to the last few slides, Melissa, and to the last part of the presentation before we tackle the rest of the questions. Do you think that makes sense? Okay. Very quickly in terms of timeline, right? Because I get this question a lot. Usually, once you're approved for a private student loan, what's going to happen next is that your lender, whatever lender you decide to work with, is going to work with your school on sending the funds to them. Okay. So let's assume you're going to school or your tuition is due in August 2026, right? At that point in time, your lender is going to send your money to your school. Okay. The disbursement happens every semester, every quarter, depending on the school. But the point here is that the disbursement starts in August 2026. Let's assume you're going for a 4-year program. Your graduation date roughly is going to be May 2030. Private lenders would offer you between 6 and 9 months of a grace period, meaning you're not obligated to pay back anything in that period after your graduation. And then by the time that grace period is over, which roughly would be February 2031 in this example, that's when full repayment begins, right? If you selected a 20-year option, then that means that by the end of, I guess by 2051, February, you'll end up paying your loan in full, okay? Obviously, this applies if you didn't select the repayment option of paying principal or interest while in school, okay? Now, if you're going into some sort of specialty program after school, there are going to be some lenders that offer you what is known as residency deferment, right? So meaning for the duration of your specialty program, your loan's going to get deferred as well, okay? Meaning you will not be obligated to pay back your loan until you've graduated from your residency program, okay? Under the same logic here, let's assume that's going to be November 2032, right? If you go to a 2-year program, that means that by November 2052, feels weird saying that number, you'll end up paying your loans, all right? I'll go through this last slide very quickly and then send it back to you, Melissa. What do I see students get wrong? Apply too late. Try to be as proactive as possible. Compare lenders. Like we do that at Juno for you, but still, we want you to shop around as much as possible. I want you to make sure you're getting the lowest interest rate possible. And as I was saying just a few moments ago, plan as much as possible for the next 4 years and even beyond that, if at all possible, right? That's going to go a long way in your personal finances. And I'm pretty sure you're going to thank yourself 4 years down the line, going through this exercise. With that, I'll let you, Melissa, go through the last section of the presentation and then we'll get to the questions in the chat.
Yes, love it. Okay. If you guys take away anything from what Diego and I've talked about on here, it's that Your credit and what you're doing right now matters, and it's going to matter the entire time that you are in school. When he's saying not planning across 4 years, we need you to make sure that you're still paying your payments, paying things on time, and doing all of that responsibly while you're in school so that we make sure that you are still going to qualify for lending and everything while you are in school. I know that this is like a concern that pops up when people ask us, like, well, what if I'm approved for year one and I'm not approved for year four? It is in the lender's best interest to give you loans for the entirety of your school because you're more likely to pay it back afterwards. However, that does not mean that like you can make poor credit choices. So our goal is to make sure that you're as financially as responsible as possible to make sure that you will be covered with your funding for the entire time while you're in school. So with that being said, we'll get to all of your questions in just a second. So now my part of my portion of coming in here is essentially like, how can I help you? I work with so many incoming dental students, residents, and everybody that's in between there right now of basically being like, hey, how do we navigate this process? Now you know what your credit needs to be, you know what your credit history needs to look like, you got a cosigner, what's the next step? So basically, my goal is to help simplify that process for you a little bit. So Diego and I have been here. Diego's been here longer than I have, but essentially Juno started in when our co-founders were testing this like experiment within their own classes at Harvard while they were doing their MBA to essentially like see if they could group all of their classmates together and then take that group to a lender and then hopefully negotiate lower student loan rates for themselves. Obviously, it worked because here we are 8 years later doing the same thing across all of the graduate programs as well as MBA. So we've worked with hundreds of thousands of students, done billions of dollars worth of student loans, but now that our focus for us tonight is essentially on dental students. So what we do is we put as many dental students into a group as possible and then take that number of students to lenders and work and advocate for specific dental related goals that we're looking for. So that includes perhaps wider eligibility so that you maybe don't have to have the perfect credit history, more eligibility with terms of credit score, not having to have a cosigner, a lower like no debt to income ratio, as well as things like residency deferment and stuff, which is super important for within that dental niche. So everything that we do is always free for students. You can and have the ability at any time to book a meeting with me, with Diego, with anybody on our team to walk through this process with you. If you finish this today and you're like, I still have questions about my own finances. I don't want to put it in the Q&A. You have the ability at any time. Talk to us for free. We'll have a meeting with you. You can do it more than once. If you get your loan options and you want to come back and talk through them because you're not sure the differences, talk to us again. So like I said, everything's free for students. One of the frequently asked questions or the things that I get the most is like, okay, well, how do you guys make money if everything is free to students? We have contracts with the lenders that are set up on the back end, so we get paid by the lenders and not by students. And that's what makes our business model work the way that it is that we can be very student focused with our goals and our expectations when we work with lenders. The second most frequently asked question that I get is like, okay, well, what are the interest rates that you're getting? Because again, pre-dental Reddit is pre-dental Reddit, and there are people on there that are getting 12, 13, 15% interest rates and such. Across the board last year, the majority of students got something similar to federal or lower, like typically around 7.5. Our goals for this year are to keep that very similar, ideally lower if possible, again, depending on your own credit and credit worthiness. So our goal is to help make this more as affordable as possible for you. So with that being said, this is how the process works for you guys. You put essentially, if you signed up with Juno, you just put your name, email, where you're going to school, when you're when you're planning on graduating. That's essentially all that it is when you sign up with Juno. Then we take that number of students. So we say, hey, we have 5,000 dental students that we have in this group. We take that number to the lenders. The lenders then come back. They give us their offers. And then in the middle of May, we send you an email that essentially says, hey, log into your dashboard. Here's a bunch of offers from you from all of these different lenders. And then you go directly from that dashboard to the lender's website and finalize your student loan with them. We don't ever do anything with your credit or credit checks or anything like that. You go do that with them, and then they have your loan, and then they will send it to the school. So essentially, you should be able to kind of see a bunch of different options, like Diego was talking about, 5 years, 10 years, this interest rate, a fixed rate versus variable, and kind of just play them out all against each other. The goal is, because of the contracts that we have set up with lenders, that if you were to compare them side by side, like if you were using one without Juno and then going to one through Juno's dashboard, that the one with Juno's dashboard would be the interest rate and what eligibility, et cetera, would be better because of the contracts that we have set up with them. So here's my caveat for this is essentially more than 50% of our dental students come from word of mouth. So my goal is for you, even if you don't end up taking anything with Juno, if somebody says, hey, do you know like where are you getting your loans from? You can go, hey, I went to Melissa's webinar and Diego's webinar. It was super helpful. Go talk to them. They might have an option for you or things like that. We work a lot with ASDA, DIA, we do stuff on campus and a lot of different types of events of basically just being like, hey, let us help you navigate this process. So along with that, you can scan this QR code. It'll set up a meeting. Like you can go to my Calendly. It'll set up a meeting with me if you have specific questions that you want to talk through. As well as here's my email if you have specific things that you also want to talk about. If you don't want to have a meeting, you just want to email me. So always available for you. Diego is also, again, available to answer any questions, especially international, because he is the international expert. So we can, I guess we don't have a chat on here, but we can put his contact info where you can get it off of our website. But my last little thing, here you go. If you want to scan it, we'd love for you to join. Again, it's free. You're not obligated to take a loan if you sign up with us. So name, email, that's pretty much it. Diego, you want to answer questions? You want me to ask you? You want to answer them or?
Yeah, well, I see Linda came back. I don't know, Linda, if you want to add anything before we start with the questions we have here in the chat.
No, we're just ending. You've already talked about it. We're coming to the end of the show, so I wanted to make sure many of our students who had questions still get a chance to ask their questions before we close out tonight. So no, I don't have anything else to add. I'll let the attendees
Awesome.
ask their questions.
I'll start knocking off the first ones I see here, and I do want to address a couple of points that people were raising on a few questions I just answered. So, someone's asking, can I max out on subsidized loans first, then starting like second semester of dental school apply for private loans? The answer is yes, right? So, actually, our recommendation is max out federal loans, right? Again, for you this year, it'll be $50,000, right, per year. If you need funding halfway through the year and you still have room in your cost of attendance, then that means you can still apply for a private loan, right? So yeah, you can very well do that. Just keep in mind on how the federal loan might get dispersed, right? You might find yourself in a situation where out of the $50,000 you're getting from the federal government, say $25,000 is getting dispersed for your first semester and then 25 for your second semester, right? So if you actually do need 50 on the first semester, then you have a delta in there, right? So that's when the private loans might come in handy, all right? Loop in your financial office. They will be able to answer those questions for you on what that timeline looks like for your program specifically. Someone's asking, if you have a 10-year plan and do well after dental school, can you pay more on your loans or do you have to stick to your obligations on the 10-year plan? That's a great question, and we actually get it very often. The answer is private lenders would not charge you any prepayment penalties, all right? So that means that at any point in time, throughout the life of the loan, including while you're a student, if you want, you can prepay any amount that you like in advance, right? Now, caveat, you will need to first pay off the interest that you have accumulated up until that point in time, and then you pay the principal, okay? Under the same, I guess, rationale, if you want to refinance your loan, what you're essentially doing when you're refinancing is you're prepaying 100% of your loan back. You're just getting a new loan with a new lender, right? So the answer, I guess, to that question specifically is yes, you can pay anything you like at any point in time, but the term is not going to change, right, on paper, but you are reducing the number of payments you're going to have to do, right? Because you're essentially paying down principal, if that makes sense. Now, your monthly payments are not changing. That's a very important thing to note, right? So I hope I'm answering that question correctly. I don't know, Melissa, anything you want to add to that one? Nope. Okay. do want to address something specifically about the Juno business model. I saw somebody asking about it. So there's no fee that Juno charges the student, right? It's all for free. Now, again, as Melissa was explaining, we get paid a fee by the lender, but it's not like that fee then gets charged back to the student. The way this business model works is that we would get paid only if you student get a student loan through Juno with that lender. But you wouldn't be getting that loan through Juno unless it's the best option in the market, right? So it's kind of, we don't get paid until you get something better. That's how we've structured this business model, right? So I hope I'm answering that concern from someone in the audience. And again, these negotiations do work. We've been doing this for 8 years now, and the more we are, the better the outcomes for everyone. Cool.
All right.
Melissa, you want to go ahead?
Yeah, I'll read the questions first. So if we get an offer from Juno, how long is the offer available for us to apply for? So when they come back in the middle of May, how long do they have to use it?
Well, technically, you wouldn't get an offer from Juno, right? So what Juno is going to be doing is going to be releasing our deal for anyone who signed up to the group, right? You can go to Juno at the moment that we release our deal. And at that point in time, you can check the rates that you will be eligible for, right? Now, once you submit an application to that specific lender, right, and that application is approved, then usually that approval lasts for 30 days, right, before you accept that approval. But from a Juno perspective, our deal is going to be open for everyone who wants to use it. And you're not obligated to use it, obviously. You just come here, check your rates, and if you like them and you decide to move forward with the rates we negotiated, then you just kind of submit the application on the lender's website.
Yes, the goal is right now when we add as many students in as possible to get that interest rate and those right criteria to be lower. You still have access to those rates up until like next year. Like right now, you could go and get a 25, 26 rate that we've had for students. So they're always available to you. You'll just, and then finalize it with lenders. So, do most private lenders offer a residency deferment?
I want to say most do, but there are some that kind of offer you a more flexible residency deferment, if that makes sense. Like, give you an example. Say one lender might say, yeah, if you go into residency, I'll defer your payments by 12 months, right? And then after 12 months, you come back and I'll give you another 12 months. Some lenders might be more flexible and say, yeah, I'll give you 48 months after school, up to 48 months or up to 96 months, right? So the answer is yes, but then the question becomes how flexible these private lenders really are, right? And one of the things we are actually negotiating with one of these lenders, or kind of in active discussions, is how do we actually make sure that whoever is going into residency or specialty programs after school, they have the most flexibility in terms of how interest is being accounted for, right? Or how easy it is to get that deferment.
Okay, we'll do the last two really quick since I know we have like a minute left. What's better, fixed or variable?
No right answer there. Honestly, it depends on how risk adverse you are. My personal opinion would be go fixed because the difference between variable and fixed is not that big. Again, if you're going to a 4-year program, you might as well do fixed and do not kind of take quote unquote the risk of going variable and then that rate going up, right? You never know what can happen in 1 year, let alone 4 years, right?
Yeah. Okay, two more. So does this mean that we can use Juno's offer in spring 2027 if we're part of this year's group?
100%. So anyone who joins right now, you would be kind of considered for next year's negotiation, right? If you didn't opt out, and then for your next year, loan, you hopefully you come back to Juno and at least check the negotiated deal that we have for next year. So we do this every year. I think I don't know if we were. I guess I want to emphasize that part, right? We do negotiations every year. Every year we do the same thing. So the expectation is that if you need a loan for your second year, hopefully you come back to check our negotiations in 2027.
Yeah. All right, then the last one. I thought if you make extra payments, that'll go towards the principal instead of the interest, similar to how you make mortgage extra payments.
No, this is true for every private lender, right? You'll first pay off interest that you've accrued, right? And then after you do that, you start hitting the principal. Now, keep in mind that while you're in school, if you're not paying interest or you're not paying principal on interest, those two repayment plans I was discussing, then you're accruing simple interest throughout all that period of time, right? So let's say a 10% interest rate on a $100,000 loan for 4 years, you're accruing roughly $10,000 per year, right, on interests. So by the time you're graduating, you've accrued roughly, $40,000 worth of interest. That's going to be capitalized towards your principal. If you pay anything in the middle of school, you're going to be hitting the 10K or 20K that you've accrued at that point in time, right? And then after that, you'll hit the principal. But it is true that you first have to pay off your interests.
Excellent, excellent, excellent. On behalf of ASDA, I want to thank you both, Melissa and Diego, for your time tonight, and Juno for your continued support as a Strategic Alliance program member, and also for the information that you provided tonight. You can scan the QR code that's on the screen to get more information about Juno, as they've talked about. But if you would like to view this webinar again, it will be posted in 1 week on ASDA's YouTube channel and saved to the webinar directory on ASDA's website under programs and events slash webinars. So we would like to remind you that when the webinar is available in a week, we will be sending you that information to let you know it's available so you can check it out. So again, we want to thank you all for joining us this evening. Thank you, Melissa. Thank you, Diego. And we hope you all have a wonderful evening.
Thank you, Lina.